Hi, I'm Scott Shelody here in London for Traders Exclusive. I was in the States last week, got a lot done, spoke to a lot of guys and gals that trade these markets, and there's one thing that we really have been highlighting, and I talked about it last week, and it's this recalibration, this normalization, big words, right? And I think we're like a prize fighter. The last couple of weeks really unsettled folks because of we got hit in the head enough that we're really still trying to find our feet, right? Like a big prize fighter that's got concussion. We're in concussion protocol. We're recalibrating. We're wondering what this world's going to look like with these rates higher. Now, everything seems to have settled down, and I have talked about recalibrating and I've talked about normalization. I mean, I like to normalize too, but you know what? If there's one thing we can say is the last 7 years have been the most abnormal trading I've ever seen in my 30 years. So how do you normalize in the most abnormal environment? I don't know. That's why it's been difficult, right? That's another one of those great unanswerables I keep talking about. So let's get back to basics. Is that what's really going to make the biggest difference here between recalibrating and normalization is velocity. How fast of a move in those interest rates changes the mood of the market, right? If we see that 10-year shoot through 3 to get to 3.25 very quickly, that's going to really put the brakes on these asset prices or these equities, and that's going to give competition to those folks that buy those dividend stocks looking for something over 3%, and now maybe I can just put in a 10-year yield. But if that happens very quickly, that's going to spook people. Now, we can still go to those levels, but if it goes over time very slowly and we have a nice trend, that keeps the market more calm. So yes, are we recalibrating? Sure. Are we moving towards normalization? Yeah. But what's going to make the biggest difference on that road from one to the other is going to be velocity. The velocity of the move in interest rates. Because if it's sharp and fast, that's going to upset the apple cart. Now, let's not get too crazy here. We're only back to asset prices or equity prices that we saw last December, right? Only a couple, 3 months ago. Well, remember all the talking heads back then said, hey, don't get involved yet. We've got a big correction coming. Be careful. These levels are overvalued. Well, now that we've broken back down to the levels we saw in December, they're all saying, hey, this is a big buying opportunity. Well, what I'm going to tell you is this, that volatility is not done with because we haven't taught anybody any lessons. I don't want everybody to lose money, but I definitely want some behaviors to change. And the buy the dippers, the folks that always know it's going to bounce, haven't learned a lesson. And look at the way this market trades. So keep an eye on the velocity. That's going to link those two words, recalibrating and normalization. If the velocity is fast, short and sharp, that's not going to be good for asset prices. If it's nice and slow and trend-like, then we can kind of get used to the levels we're trading at, and things should be okay. So that's the big key word of the week is velocity. Let's see how that velocity reacts or how things react to the velocity going forward for the next 4 or 5 days. But that's it from me. I'm Scott Shelody here in London for Traders Exclusive. I'll see you again next week.